The Canadian dollar is tanking right now. So what is going on and what is causing this, and where is the Canadian dollar headed? So let's get right into this. I'll take you over to the chart. So basically, last Friday, what we had happen was a GDP report came out. The GDP report preliminary figures for August were for growth of 0.1%. July was flat at 0%. So that will probably be revised down, and obviously the market agrees with that. But this GDP report came out, the Canadian dollar just absolutely tanked. So it was up about 1/3% on Friday. And then that report came out, it closed down 0.75% on Friday. So the move was around 1%, which is very, very extreme for a major currency pair like the Canadian US dollar. And all on the back of that, you had oil prices, which were pretty much flat. So oil prices weren't doing much. I don't believe there's much of a correlation there anymore between oil and the Canadian dollar. I mean, I did an overlay over the Canadian dollar the other day, and there's really not much correlation there anymore. And that doesn't surprise me because, you know, the energy industry has been truly crushed over the past decade in Canada. So let's also take a look at what is going on with Brent. So Brent oil has just absolutely tanked. It's down over 5% today. So what on earth is going on in markets? Obviously, you probably heard as well that yields have been spiking. We've been seeing the long end of the treasury curve and the long end of the bond market just go up and up and up and up at breakneck speeds, which is never a good sign. When you have this sort of volatility in the bond market, which is much larger than the stock market, that is never a good sign. And when you see on top of that also things like gold going down, that really starts to signal to me that we are getting into a liquidity crisis and people are selling whatever they can sell, which is gold, it's treasuries, and it will even come to oil like it is right now. I mean, this is a very, very big move for oil, down 5.5%. So let's take a look at the 5-year, because that is what most people look at in terms of the yield, what has been going on with the 5-year. The 5-year has just gone absolutely parabolic since it hit this low here at 3.7%. It has gone up. It's at 4.3%. Like literally, you've seen this massive move just over the past couple of weeks, and mortgage rates, they can't even keep up with how fast bond yields are surging right now. And obviously what people fail to understand about that as well is there's a risk premium. You know, the 5-year fixed rate mortgage is not just based off the bond yield and that's it. No, there's a risk premium that goes in there. So if there's insane volatility with the bond yields, you're going to see that risk premium spike, especially if you have other things that are going wrong like gold. And gold has been particularly affected. In fact, if you overlay TLT to gold, you can see that the correlation there is unbelievable. So that really says to me that there is becoming a scramble for collateral right now. So if you look at this chart, you can see that gold and TLT on this daily chart, TLT is just an ETF for long dated treasury. So you're talking 20-year treasury note. You can see that gold has pretty much followed it to a T. And that's pretty much been the case. You can go all the way back and see when the correlation really started was around August of 2022. That was right before we had the gilt market that blew up in the UK. And you know what is happening in the bond market right now is just not good at all. When you've got treasuries that are going up, I mean, if we pull up the 10-year, which is often, you know, really dictates mortgage rates a lot, you can see that the 10-year is just absolutely spiking. So the 10-year has gone up massively. Again, that's going to impact the US housing market. It's going to impact the US economy. Yields are pulling back a little bit today. We'll see whether that continues. I mean, that is a strong trend. That's all I'm going to say. So you can't really predict markets when they're doing these type of things, because obviously I believe these yields are going to spike and spike and spike, and then you're going to hit some kind of crisis. I believe we're seeing the system break down right before our eyes. And how long is it going to be before the central planners come in because something breaks, which is major? So anyway, let's get into that GDP report and talk about that a little bit. So obviously this GDP report came out on Friday. This was what what the Canadian dollar really reversed on, and it was weaker than expected. What I really think the markets are starting to price in with currencies like the Canadian dollar, you're also seeing the same thing with the New Zealand dollar and the Aussie dollar, where I think they're starting to price in the risk because of things like the housing dependence in Canada. You know, the housing market is becoming of particular importance to investors because they realize that the Canadian economy is so dependent on the housing market and it's in a bubble. As we've discussed many times on this channel, the bubble is obvious, and this is not even an up-to-date chart, but this shows you how extreme it's got, how it's got miles away from incomes. And if you look at what's happened here in the past, it goes up away from incomes and then it comes back down and corrects. And you know, during this time, if you expanded this chart, you would see that it's actually quite a big divergence that happened then in 1981, and you also saw here as well. And look what happens to the housing market when the economy is in recession. It doesn't mean a good thing. It means a good thing for housing affordability, which will be a relief for lots of people to hear. But the thing is, that mainly happens because demand absolutely tanks, because a lot of people can't get mortgages, there's a credit crunch, and you know, Canada isn't going to somehow avoid the credit crunch this time. You know, I saw a video by the Plain Bagel, another fellow YouTuber. A lot of you guys actually sent me that video. I'd already seen it, and I just could not believe that he didn't even discuss this chart right here. I mean, I have nothing against the guy. I think he does some really good content actually. But his housing market video, it seemed riddled with bias to me, because I was questioning, why are you avoiding the elephant in the room, which is debt and affordability? Because he talks about how the banking system is stable and, you know, there's all these different things that are propping up the housing market, but he never comes back to the main fundamental of a housing market, which is affordability. And like I said many times on this channel, it does not mean you cannot decouple away from fundamentals and affordability. Obviously, we see housing markets in mania. We've seen that over the past 3 years. There's still a mania in Calgary. If you want to come and bid over asking price on a house right before a recession, come to Calgary. And we got plenty of people who are just completely brain dead. They are obviously not looking around, because I've spoke to so many business owners through this channel over the past 3 weeks here in Calgary, and what I've heard about the economy, what I've heard about their business, my gosh, it just makes me laugh at what is going on in the housing market. These people are the dumb money, essentially. But you see that time and time again with bubbles, but I find it such a spectacle to look at when you have things like this happening. So the housing market running away, it doesn't matter if you have high immigration, it doesn't matter what is going on, unless you've got the income growth to back up the high prices, then it's going to correct to reality at some point. And usually that is going to be when there's an economic crisis, as we can even see in Canada that we've had in the past. And if you look at the bank stock, significantly weaker than a place like the United States. The bank stocks are in full decline. You can see over the past month alone, Bank of Nova Scotia is down 8.36%, CIBC is down 5.89%, National Bank down 7.15%, Toronto Dominion down 3.98%, and Bank of Montreal down 5.22%. I'm just going to get rid of National. Okay, I just added in RBC there so you can at least see that as well. They're down 7.07%. So the bank stocks are down significantly, and if you pull it out to 5 years, this is really interesting. So you can see Royal Bank, Toronto Dominion Bank, TD Bank, and Bank of Montreal, they're actually up. But if you look at Bank of Nova Scotia and CIBC, you're talking about 5 years. So get rid of what happened during the pandemic with all the stimulus boom, the amount of money that was injected into markets. The Bank of Nova Scotia is down over 20%. And the Bank of Nova Scotia is involved in a lot of shady stuff, in my opinion. So is BMO when it comes to China. God knows what effect that is going to have. Obviously, the Bank of Nova Scotia is one of the only banks that is actually directly passing on the cost to their consumers for the increases increases in these variable rate mortgage rates that we've seen. When they hit their trigger rate, they have to pay more. They can't go into negative amortization like they're doing at the other banks. So the other banks are masking a lot more, but it's really crazy when you just look 5 years, wow, and they're down that much. So it's just kind of crazy, the volatility that we've seen in these bank stocks, but it's kind of what you would expect towards the end of a cycle. You would expect this kind of blow off top. I mean, the bank stocks practically followed the housing market. They went way higher than they were before the cerveza sickness. So if you look at the stocks, you know, they're around here. And then if you look at the chart, they got way higher than that just with the housing market. And now they are coming down to reality. Markets are starting to price in. These banks might not be as quote unquote resilient as everybody believes. So it's kind of crazy what is going on in the marketplace right now. The moves we are seeing in the market are indicative of a liquidity crisis. October is a month where the probability is very, very high that we would see this sort of events due to the moving parts that we have with money that happen during September and October. These are typically the months we see crises happen, and that's why we saw the gilt market blow up that occurred in October. Normally you have the spring where liquidity gets short, and then you have the fall, and we're going right through that period now. And the thing is, things haven't got better since the spring. Things haven't got better since the gilt market blow up either. Really, what is of note here is how much currencies are moving. And I want to take you to something else which is really interesting. The United States dollar is gaining ground against the Mexican peso. Finally, the dollars are starting to come back from Mexico after this unbelievable sell-off. You know, the dollar versus the Mexican peso was down massively, but now those dollars are starting to come back. Maybe that's going to mean a future opportunity in Mexico. I mean, there is definitely real estate bubbles all over where expat money and stimulus money has just fed into these markets. And I think it could be an opportunity in the future, but we'll have to see how this plays out. So it's very interesting what is going on. The volatility in the major currencies, not a good sign. And the fact that that was sparked off the GDP report tells you what the market is thinking. The market is very, very worried about what's going on in Canada. So anyway, I want to thank you so much for watching this video. If you've enjoyed this video, you might like this video here, might like this playlist here. If you're looking for a VPN, which you desperately need because of Bill C11, we'll get onto that in another video, go to expressvpn.com/market mania, or just buy any VPN, quite frankly, and I will see